Literally, you could pick how much money you wanted to pay, what your monthly payment was. Are we going to have another market crash like we did in 2008? The answer is no. And I'll tell you why. And listen, it's a very fair question. I get this question a lot, especially from those of us that have PTSD from what happened in 2008. And we see, prices are just going up, 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 up. And it's like, how much higher can they go? And so are we just going to have this bubble burst and everything's going to come crashing down? Now, let me explain to you what the symptoms were going into the 2008 crash versus where we are now. I do have concerns about the market where we are right now, but they're different than what happened in '08. If you look back and if you remember, in 2008, what was happening was we were issuing 100% loan to value mortgage loans. So that meant that if your house cost $500,000, you could get a mortgage for $500,000. You really didn't have to put much, if any, down. And there was something called stated income loans that were very prevalent. So you could just basically tell the bank how much you made, and they didn't do a whole lot of income verification. We saw a lot of, business owners and whatnot would be able to kind of state their stuff and not have to provide a whole lot of documentation as well. So there just wasn't a lot of vetting that went on in mortgage applications back then. And buyers didn't have skin in the game. That's the reason why lenders like to have down payments and higher down payments, because it gives a buyer skin in the game, and the chances of a default when a buyer has ponied up their own hard-earned money are much less. And so that's why, lenders like to have down payments. But back then, down payments weren't even much of a thing. Income verification was practically non-existent. The type of loans that they also offered, if you remember or if you don't remember, they called pick a pay. Literally, you could pick how much money you wanted to pay, what your monthly payment was. So you'd get a mortgage statement and it would have 4 options. And so option number 1 is the highest, and it was based on a 15-year amortization. Option number 2 was a little lower, and it was based on a 30-year amortization. Option number 3 was even lower, and that was interest only. So you just are paying the interest, not touching your principal. And option number 4 was the lowest house payment, and that's called negative amortization. That didn't even cover all the interest. So you would pay a portion of interest, none of the principal, and then whatever you didn't pay of the interest got tacked on to the balance of the loan. If you chose the the negative amortization, every single month that you're making a payment, your mortgage balance is increasing. So you're not paying off your home, you're actually owing more every single month. So none of that is in existence anymore. We don't have 100% loan to value home loans. There might be a few exceptions with veterans, but by and large, they're gone. We don't have these pick a pay. We don't have negative amortizations. Interest only loans are very few and far between. So we're in a much healthier environment as it relates to the mortgage products. They're much, much healthier that we have right now. But even more importantly than all of that, in 2009, 28% of homes were underwater. So over a quarter of all homes were underwater, meaning homeowners owed more than what the house was worth. Compare that to 2024, 1.7% of homes are underwater. You go from 28% to 1.7%. We don't even have 2% of homes that are underwater now. We have so much equity. Second statistic is at the worst of the housing crisis back in 2008. I think this was actually in 2009, 36% of homes were delinquent on their mortgage. They were distressed. Right now in 2024, 1% of homes are actually in default. And these stats came from CoreLogic. So we're just in a very different environment because people have equity. In the 2008 crash, They didn't have equity. So they were upside down. They couldn't make their payments. Their payments then would adjust. So those that got really used to their NAM payments, all of a sudden, maybe it was only neg am for 3 years, and then it would adjust. And now, instead of your house payment being $2,500 a month, now all of a sudden it's $3,200 a month, and people just couldn't afford that. They never could have afforded it to begin with. So this is how people slip farther and farther behind. This is how, housing became very, very distressed. And then this is what caused home values to really plummet. I mean, it was like a snowball going downhill. We could barely even get in front of it. So we're just in a very different environment. We've got healthy loans. We've got tons of equity everywhere. We've got cash buyers that are buying homes that have 100% equity. So we're just, we're in a different environment. Now, does that mean that home prices aren't going to come down? Well, there could be other extenuating circumstances like the economy, or if we've got certain industries that are vastly affected by our new administration's job cuts or whatever that's going to be. There could be these external factors that could indeed impact the housing market. Right now, all eyes are on interest rates. I mean, it's really interest rates is the biggest kind of lever that the feds have to push and pull, and that's really guiding kind of the altitude, so to speak, of our housing market and of our home values. So that's really the thing to watch right now. I would love to see more building going on. We are drastically at a shortage in all over the country. Certainly in California, we are, where we just have a supply and demand crisis. We've got such low inventory and such high demand, and affordability is lower than it has been in decades. So how much longer can we stretch, that affordability issue? I mean, it's gone on a lot longer than I thought that it would, but I definitely think, interest rates is the number to watch. We're not going to have another '08 housing crisis. We've learned from it, and there's been too much regulation and too many, guidelines that banks and institutions have implemented to prevent us from having something like that again. So no, it's not going to crash. Yes, keep watching our house prices, but we're not going to see a massive bubble burst like we did. So anyway, hopefully this helps. If you have any questions, please drop them in the comments below, like, subscribe, and look forward to seeing you next time.